We have with our market experts to help us navigate through the markets. We have Sharan Delane to help us through the technicals of the indices and his stock-specific approaches. And for the long-term perspective of the market, we have market expert Sunil Subramaniam joining with us. Gentlemen, good afternoon. Thank you so much for giving your time to ET Now. Sharan, we'll start with you and quickly need your view and strategy on the indices. It's 24,880 and above on Nifty, but Bank Nifty is still quite volatile.
Good afternoon, everyone. So Nifty is also very quiet, a very lackluster day, very boring, sideways to say, but still something is better than nothing. So Nifty is about to close around, I think, 24,900 odd levels, and I think if it continues above that level, you can see 25,000 levels tomorrow. And looking at Bank Nifty, very flat, nothing at it, though it did test 56,000 levels on the downside, but quickly recovered from that level also. Again, the levels remain the same, 56,500 a resistance for the Bank Nifty and 56,000 immediate support. If at all it trades anyway on any side, I think we can see some movement coming in tomorrow.
All right, so that's about Nifty as well as Bank Nifty. Very sideways moves as what we are seeing right now. But there are a lot of stocks that are going to be in focus on the back of the earnings. And in the latest, it's M&M that has come out with an announcement indeed, wherein tomorrow is when we were expecting the numbers to trickle in. But an announcement has come just now, before a few minutes rather, where the company has said that not tomorrow, but even today is the company when they will be declaring the results. So let's quickly tell you what is the street really penciling in when it comes to M&M. And this time around, what we see is that it's expected to be a good set once again for M&M, specifically for their tractor division. Look at the jump in the volumes. It's a 52% uptick on a sequential basis, while for the automotive division, it's been a 10% growth on volumes. But this time, on the back of the higher contribution because of their EVs, the auto EBIT margins is expected to decline a bit, but shouldn't be much of a concern. Like on the margin front, 8.8% is what we are expecting. When it comes to the tractor division, that's expected to be healthy at 18.9%. But yes, of course, on some of the upcoming launches that the company is planning and how they see the demand shaping up for both of their segments is something that we will be watching out for. So indeed, M&M will be in focus as of now. On the back of this announcement, indeed, we are seeing a bit of a surge coming in on this particular counter. But just wanted to get your take, Sharan, quickly, if you can help us with a chart check on M&M. A bit of a surge, what do you make out of it?
So Srishti, I think the stock has been consolidating around 3,100 to 3,300 levels for quite a long time. And I think post today's results, I think you can see some kind of positive action. But looking at the chart, it is almost near its all-time high levels of 3,300. And if at all the results are above expectations or even better, or the commentary that comes in can be good, you can see a sharp uptick to 3,300 levels. And if you get a breakout about 3,300, you can also see levels of 3,400 coming. On the charts, trading above all its moving averages, quite strong. Also seen quite a bit of accumulation in the last 6 to 9 months. So obviously we'll wait and see how the results are. But looking at the chart, I think you can see a good uptick till 3,300.
Absolutely. An uptick till 3,300 is visible, at least when we see the chart patterns of Mahindra and Mahindra. We'll keep an eye on that. And yes, a news flow and an impact coming in on the back of the news announcement, which we see. But let's also take a fundamental view of the market. And for that, we have Sunil Subramaniam joining with us. Sunil, good afternoon. Thank you so much for giving your time to ET Now. And quite a choppy market at present. And this is the time where we not see the short-term perspective of the market, because the direction is missing and the triggers are missing. Not that we don't have any triggers. It's the earnings season. We are in the middle of the earnings season. It's a mixed bag. The global front, tariff scenarios, all of it is quite volatile, contingent and uncertain. Now, how to find a proper entry opportunity in the market is a big question at present. What's your take on the texture of the market at present? Because there's a lot of sign of fatigue and mild growth slowdown, which we clearly see at present in the market.
Thanks. I think you did a good summary, Mansi, but let me add a little bit of flavor to it. So where I see is that, the market, if you look at the 3-month returns of the indices and the 1-month returns of the indices, it'll tell you the whole picture. Because in 3 months, if I recollect, I think the Nifty was probably just 2.5% up. and you saw the mid cap index at about 7%, small cap at about 10%, right? But you see the 1 month, it's a different story. You have the Nifty and the small cap and the mid cap, all under pressure. So what this is telling you is then you got to look at the flows, which is what has decided this. So what happened is that April, May, June saw a strong buying by both FIIs and DIIs. Of course, DIIs was a huge outnumbering the FIIs. So that's why if you see the mid and small cap indices largely outperformed the large cap index in the 3-month period because of the strong domestic buying, right? But I think what's happened, and this started with the earnings season rolling out last quarter, which is for the Jan, February, March quarter, from April middle onwards as the earnings came out, DII stepped in and domestic mutual funds especially stepped in, and as they got clarity on earnings, they did buying of good mid caps and good small caps, and they looked at them as the growth drivers. Now, bear in mind that there's a huge valuation difference between mid caps and the large cap. Large cap is around 22, 23 P. Mid caps and small caps are at 32, 33 P. So despite the higher valuations, domestic fund managers bought those stocks as the last earnings season flowed through, right? Now, come to this, starting from July, what has happened is 3 things have happened. So first is FIS has suddenly turned. I think they're close to probably 45, 50,000 crores they've sold just in the month of July, which means almost all the money they brought from April to June, they've sold in this month. So dramatic change in outlook on India from the FIS. That's the first factor. Second is DIS, if you see, right, while they have bought in about 50,000 crores this month, right, which means they are actually rupee for rupee matched the FIS selling with their buying. Certain key things step in here, right? This 50,000 crore buying is less than the 65,000 crores which you saw in the previous 2 months. So clearly DII buying has also come down. Why? Because I think domestic mutual funds who had built up their cash balance to about 7.5% of the total AUM used all the cash up April, May, June, and by June end, their cash balance was back to a normative 5 quarter, right? So this month, only the fresh flows of SIP, whatever has come, and a little bit of surplus cash they've been able to deploy. So why I'm given such a long explanation is that now when you look at it, why did the FIs change their mind? FIs changed their mind because of 3 key reasons, right? One is US continues to be attractive because the rate cut doesn't seem to be on the horizon. So the interest rates are high there. But US growth is also quite decent. There hasn't been anything. Inflation is a concern on which Fed will opine today, but there doesn't seem to be a rate cut in the immediate future. So US with higher yields from a debt side is an attractive market. Second, China. China, as you saw the IMF data today, they've upped the growth rate for the current year to 4.8%. But China has half the valuations of India at 11 PE. So clearly a lot of allocation has gone to China because of their improvement. The fact that they have come close to a trade deal with US, discussions are on, but at least their tempers are down. And look, but India, unfortunately, the third thing affecting us is that it's unlikely that a BTA is going to be signed before August 1st. We have only 2 days left. And Mr. Trump indicating 20 to 25, which was yesterday. But right from the beginning of the month, you can see that there was no news flow coming that a deal is close. India's trade delegation came back, but there was no development because I think India is taking a very strong stance on certain non-negotiables like agri, dairy, genetically modified goods and the like. So it looks like we are not going to yield on that, and so a deal is going to be not that easy to conclude. Now a US Trade Commission is going to come in the middle of August. So which means that automatically the 26% tariff which was put on a pause will kill. So this 20 to 25 that Trump is saying is nothing new. His 26% was anyway going to come on track. So FIs changed their mind because China was looking attractive, US was looking attractive, and India with the BTA slipping out of our hands. Now it looks like only in fall. So just to finish off my point, so this selling by the FIs, while the DIs have also put in 50,000 crores, the fact is that they stocked up on mid and small caps. And you look at the earnings, mid and small caps have beaten large caps in terms of the earnings growth. They are a double digit with high single digit for large caps, but they don't justify the 32, 33 PE. So fund managers are booking profits at mid cap and small cap to buy some of the large caps that's there. And where are they going buying? Where there's a sharp correction. IT index year to date is 23% underperforming the Nifty. So there's a huge correction. So despite all the negative news around IT earnings, it's like it's coming into a value zone, so there's buying there. So
Yes,
essentially,
indeed.
what we are seeing,
So it seems like it, since the fact that we are also getting to see some of the earnings that have trickled in, case in point being KPIT Tech. But yes, what all you have been saying is indeed making sense. That seems like there's not much of a deviation, and something of this sort is already in the price. But moving on to the next story then, and on to an ETNOW exclusive, wherein the Agriculture Ministry has rather approached the Finance Ministry in a move to rationalize GST for agro-pesticides and farm equipment. My colleague Prakash is here with all the exclusive details. Take it away, Prakash.
Yeah, it's a positive development for the agriculture sector, as GST on various farm products likely to be rationalized in order to bring down the overall input cost. A very significant development coming in. In fact, the process has been initiated. Sources are indicating that the Agriculture Ministry has approached the Finance Ministry on this issue once again. A fresh proposal has been submitted after a wider consultation with the industry. In fact, sources suggest that the GST on pesticides likely to be rationalized in line with fertilizer products that could be brought under lower GST slab from existing 18%. In addition to that, the definition of pesticides may be amended as well based on their uses. A very crucial development coming on to other farm-related products, essentially equipment. Sources are indicating that the GST on equipment such as tractors, pumps, other irrigation items will be rationalized as well in order to bring down overall input costs to support farmers. A very crucial development coming in. In fact, the GOM on rationalization is considering the proposal. However, the final report is yet to be submitted to the GST Council. And of course, the GST Council will take the final call after wider discussion.
Okay, so that's an ETNOW exclusive. GST on agri products likely to be rationalized soon. Prakash, thank you for all of those updates. We'll keep an eye on that and help you with all the updates that come our way. Moving ahead, we also have another technical expert joining our panel. We have Nagaraj Shetty, technical and derivative research analyst, HDFC Securities, joining with us. Nagaraj, good afternoon. Thank you so much for giving your time to ETNOW. As we see, there's a lot of stock-specific action on the back of results, but at the same time, the action on the indices is still missing. It's a quite range-bound market, at least Nifty trying to hold those gains of 24,850 and above. But what's your view on the stock-specific front? What are the trading ideas from your end?
Hi, good afternoon, Nancy. Nifty has been in a range-bound action, but what we can observe in the last couple of sections is a little bit of turnaround from the lower levels. What we have seen over the last few weeks is a continuous downtrend from the higher levels. It was merely a gradual downtrend from the lower tops and bottoms. But yesterday's bullish engulfing pattern and today's consolidation and just moving above from the consolidation is indicating there is a possibility of some more upside in the near term. Once it moves above 24,900 levels, we could see Nifty reaching towards the next hurdle of around 25,250, 300 in the next few sessions. So on the stock fronts, we have seen some healthcare pharma stocks looking very well in today's sessions. I have two stocks from that segment. First one is Sun Pharma. Chartically, Sun Pharma has been in a larger consolidation phase, where technically we can say some kind of accumulation was going on. Currently placed at the higher end of that consolidation, around the 1730-35 levels. So one can look to buy at this point of time, currently trading around 1733, and the upside target would be around 1830. One can place a stop loss at 1680. Second one is PI Industries. PI Industries was moving in a larger range bound in the last 2 weeks. It was after a sharp upside momentum for the past few months. The trend remains intact. The recent range bound action seems to have broken above the recent hurdle of around 4200, currently trading higher. So now trading around 4316 levels, one can look to buy at this point of time, and the upside target will be around 4570, and one can place a stop loss at 4150.
All right, so those are the calls coming in from Nagesh at this point in time. But moving on, and some of the other news flow that the globe will be tracking is, of course, the FOMC meet outcome, because the Wall Street may be eyeing that actively, and so will be the case for the other global markets as well. And this time around, the investors are majorly expecting the rates to remain unchanged. However, the Trump's push for further rate cuts, that will materialize or not, that remains to be a question. Ankur is here to tell us what to expect. Ankur.
Yes, all eyes on US Federal Reserve meeting outcome, as expectation is that there will be unchanged rates this time at 4.25% to 4.5%, and that has been continuing since December last year. Now Fed is likely to revise the 2025 GDP and inflation projections, but it may remain cautious amid global uncertainties and rising tariffs. Even the inflation pressure is persisting in United States. Also, the clues on internal dissent will be there, because you remember last time a member did dissent about cutting the rates in the last policy itself. So it will be interesting to see the dot plot how they are projecting rate cuts later this year, whether it is 1 or 2. That will be interesting to watch out for. Now, what happened in the last policy? In the last policy, the rates were kept unchanged, and the real GDP growth and unemployment rate was tinkered last time. And in fact, if you talk about last few meetings, at least 4 times after December 18, there has not been any change in the rates, but there has been divided opinion if you talk about how many cuts should be there later this year. US President Donald Trump has been quite vocal about US Federal Reserve needed to cut rates, but all eyes will be on Powell, whether or not he bows on that pressure. But interesting to see the dot plot which will be presented in the press conference.
Absolutely, Ankur. All eyes on FOMC meet interest rate decisions and the commentary coming from Fed Chair Jerome Powell.
Welcome back to Closing Trade right here on ETNOW, where we are tracking the markets, and it's just last half an hour of the trade that is indeed left for the markets to shut shop. But tomorrow is going to be a very interesting one. Not just we will have the outcome from FOMC, a lot of earnings, and along with that is going to be the monthly expiry as well. So let's watch out for all the action there. But Sunil, the top gainer for today remains to be L&T. Yes, of course, not just the earnings, even this got a thumbs up from the brokerages as well. What's your own sense on L&T, given the fact that the stock as a whole has underperformed the Nifty on a 1 year basis? And if we will see the outlook, or rather the growth outlook, that remains to be quite good, specifically with respect to the private capex that the company has highlighted.
Yes, well, I think that, well, I can't talk specifically about the company. I think the guidance that they've given in terms of private capex, I think augurs well for the entire capital goods space. So it's not just that, because as you know, it's a large company and it will not execute all on its own. It will in turn subcontract to a large number of mid and small capital good suppliers. So I think it augurs well, and private capex has been the one lagging number for Indian economic growth, which has not been picking up. So I think it's good signs, early signs of that revival means that overall it could be very good for the overall mid and small caps especially, and for the infra cycle and for public sector banks. So I think this was a very encouraging set of numbers that came through. And as you mentioned, more than the numbers, it was the guidance that was the thing. And the reason why so far, because of the private capex not growing, was where companies in this infra space were getting hurt, because analysts were downplaying them in terms of saying that when will private caps pick up. But with the green shoots not coming now, seeming to come through at the ground level, I think it's augurs well for the future for the capital goods space. And that's the takeaway I would take from the earnings results today.
Absolutely. Now on the ticker in the lower bottom, as you see, Power Grid results and the margins figure is 8,000. Margins figure is 81.8% versus our estimate of 86%. 82% is what the margin figure has come up. Apart from that, the revenue front as well as the profit front, we see around a year-on-year 7% upsurge in the profit front. The number is 3,653 crore versus 3,412 crore. And at the same time, the revenues have also seen an uptick of around 1.5% at 9,928 crore. The stock is reacting at present, and as we see at 289 to 90 levels. Power Grid will take a technical check on that as well. But we have Siddharth Khemka, Head of Retail Research, Motilal Oswal Services, joining with us. Siddharth, will come back to you. Just before we let you go, Sunil sir, one last piece of advice for the market participants. At present, we see a flux-like situation. Let us know what should be the strategy at present, because we have a lot of triggers. The earnings season is up and running. At the same time, the interest rate decisions, RBI credit policy and monthly expiry for tomorrow also. On a shorter term basis, what is your view? How should the market participants behave?
So I think that first of all, I would recommend to them to take a slightly medium-term approach, not to take a very short-term approach, because the congestion in the market is likely to continue till there's clarity on the BTA front, I think. But that being said, right, I think because of the lack of clarity on BTA and the FIS selling, I think what you need to start accumulating, and I would say have a consistent buy on dips approach, is on sectors where the FIIs will buy when they come back. So then what stands out is if you look at the large cap index allocation, BFSI is about 30%, IT is about 10%, and FMCG is about 6-7%. So I think these are the sectors where I would say that when FII money comes back into India, and it's only a matter of time, because like I said, there were specific reasons why they went out of India this month. But if there's any good news on the BTA or saying that something will happen, they will come back. And I think that if you keep your focus around those, because those are the things which have underperformed because of lack of FII buying. So I would say pack a contrarian approach. Buy on dips. It's not as if you buy today and immediately go up tomorrow. There could be a series of small corrections happening, but keep sticking with a medium-term approach and keep your eyes open on the FII space, what they are likely to come back and buy. The second is taking a read from the L&T results today. Clearly now the capital goods sector looks like the future will be good. So I think to that extent, from a medium-term perspective, revival of private capex augurs very well for medium-term growth. So I would encourage everybody now to look at the infra and capital goods space, but again, buy in a staggered way, not to put all your money at one time. So I think those two, if you keep in the back of your mind, along with the capital goods, I would expect public sector banks to lead the financing of the capital goods companies. So I think the loan growth for the public sector banks on the corporate side would be much better than the private sector banks because they are more ingrained in that business for many years. So I think these are the top things that I would keep in mind at this point of time in terms of taking a future approach.
All right, so that's the strategy that one can look at adopting at this point in time. But with this, we let you go, and that's Sunil. Thank you so much for taking the time out and speaking with us.